It's time now to talk renewables again, and a new way of gaining exposure to this exciting area of investment. Triple Point Energy Transition plc is a renewable infrastructure trust managed by Triple Point. It invests in niche areas of the energy transition market to find returns with UK assets, including large allocations to hydropower, combined heat and power, CHP, and battery storage debt. And some of these are areas where you might find it difficult to get exposure in other areas of the market. Well, Jonathan Hick is the manager of the Triple Point Energy Transition Trust with the ticker TENT, a nice easy one to remember. Jonathan, welcome. It's great to be able to catch up with you. There's something new to me about this, and certainly areas that I've never discussed before. Explain more about what you're trying to achieve for Energy, the Transition Trust.
Sure. Well, thank you for having me on. What TENT is trying to do is offer investors access to some of the more niche and overlooked parts of the energy transition, where you can still get really interesting returns on a risk-adjusted basis. So in our portfolio, as you've just mentioned, what you're not seeing is some of the big, names in the renewable power sector. So you're not seeing offshore wind or onshore wind or large-scale solar. That's because there's a wall of money going after those assets, which are driving down returns and pushing down yields. We think it makes sense to be more nimble. So what we do is look across the whole of the energy transition, which we segment into three areas, which I'll come on to in a sec. And we look across the whole of that spectrum to find the overlooked areas, the niche areas, the kind of really interesting risk-adjusted returns. So the area we look over is kind of three segments. First is energy generation. We've done hydroelectric power in that sector because we think it's got a better risk premium than, say, solar and wind. The second segment is storage and transmission. If you think about those electrons flowing from that renewable resource through towards the home, increasingly we need to balance that power, and so battery storage is quite important there. And then the final segment we look at is on-site. This could be anything from combined heat and power, as you mentioned, LED lighting. It could be heat networks, green hydrogen, EV charging, electrification of commercial fleets, are really interesting and probably the most fast growing of all of our areas. And when you look across all of that, you get diversification and some really interesting opportunities, and that's what we do.
Picking up on the recently released earnings you had, I think were through to the end of March. They were released a couple of weeks ago. NAV, 9.2%. I think the dividend's approaching something like around about 6%. How has all this been achieved? Give some more depth on where the earnings are coming through from.
Sure. So, yeah, we're really pleased with the year that's just gone. We kind of, when we listed the company, we sort of targeted up to 8% return. So we've overachieved on that front, and our dividend cover was 1.1 times or 1.2 times, excluding exceptional. So good, strong set of results. Where are those cash flows coming from? So predominantly in the year just gone, they came from our hydroelectric power portfolio. We own 9 assets spread across the Highlands of Scotland, where it's pretty reliably rainy. And we use water resource to generate electricity, and we also get government subsidies under something called the feed-in tariff. So the hydros is a really, really neat revenue structure where we have a generation payment under the feed-in tariff, but also a price floor. And some of us can remember back to March 2020 when there were negative power prices, and that's hard to believe now, but it is can be a volatile market, and we think that price floor is what's investors who are looking for stable, solid income-generating returns kind of want. So that's a big part of the earnings for us from those two sources of revenue generation and power sales on the hydro portfolio. What's unique about us is we do debt and equity investing. And we do that to give investors a good mix of downside protection through debt and upside potential through equity. So the other earnings came through interest income payments on our investments through loans to combined heat and power companies, which provide heat and electricity to agricultural growers and the broader grid. And we also derive income from our battery energy storage portfolio, as well as other loans to LED lighting companies and solar developers that we've invested in as well. So 5 investment areas, but the bulk of the returns in the period that we're referring to came from hydroelectric power.
It's interesting, isn't it? You're talking about this floor of income. As you say, that's a sort of safety net, I suppose, really, for people wanting to invest in this. How has the year started? Because it has to be said, it's not been a particularly good, well, I think a year actually, to be fair, year to date for the UK markets, and especially the last 3 or 4 months or so. How has the new year started since you produced those figures? As I said, went to the end of March.
Sure. So since, I guess, April, and we're talking about, clearly power markets have softened a little bit. So the prices that people are able to achieve for selling electricity, say through our hydro plants or through trading it through battery storage, have diminished somewhat. So we are quite fortunate in that we've locked in the power prices some time ago that we sell our electricity for. So we're not impacted by that market movement. That's why I think our shareholders invest in tech. They like that downside protection, that high level of contracted income. 92% of all of our income over the next decade is contracted already. So we're a very well downside protected vehicle. And I think as you see the softer power market and just you see softer inflation, both of those things mean I think it's quite important to have good downside protection, which we have intent through that uniquely high level of contracted cash flow. So yeah, the market has softened a bit. I would say, in terms of asset performance, in terms of operational availability, that's been in line with what we would expect, certainly in our portfolio.
Well, let's take a look at the evidence of this. I think really on the share price chart for the Triple Point Energy Transition PLC. As I said, you can bring this up on the IG platform just by dialing in the ticker TENT. It has done pretty much what the market's done, to be fair. I mean, the shape of this very well. This goes back to 2020. And it's tough. I know it's tough out there, but you talk about the reliability of income. Clearly, or I've got to ask the question, do you think the market doesn't understand what you're doing?
I think that the market for our shares is extremely constricted compared to a large company. So I think TENT has got gross assets of around 130, 140 million and net assets of 100, right? So we're one of the smallest investment trust players out there. And our daily volumes are typically somewhere between 50 to 70,000. When you compare that to some of our larger peer group, it will be 1.5 to 2 million. Why? And I think it may be obvious to some of your viewers, but just to explain, daily liquidity is really important. You can't move the share price if nobody trades the shares or if there's very thin volumes. So I think we suffer from a function of size, being slightly smaller than others. But what I would also say is we also are trading in line in terms of, relative to our net asset value compared to some of our larger peers, such as CIT PLC or GCP Infra. So I think we're broadly in line with the rest of the market, as you said. And we also suffer from being a sort of slightly smaller player, which means that we're really well suited to retail investors and those sorts of players to come in and own our shares, and as opposed to very large institutions. So we think we're small, but actually what we do is to a really high standard. We're delivering the results that are kind of ahead of market in terms of div cover and sort of NAV return. So we're doing everything we can, and I guess it's a function of liquidity impacting the share price, along with, as you say, the broader market moves.
So where would you say the shares ought to be? Let's go back to the share price chart again. You've got 65.5 is the reading at the moment here in the London markets. As I said, I think it's about £66 million, I think, in market cap. Where is it better valued up on this downdraft you see here? I mean, even if we're talking at the back end of last year, it was 85 pence or so. Here we are now at 65.5. What is the true valuation of the assets you're holding, do you think, in terms of the trust price?
So the audited net asset value, the value of those assets, is a little under £100 million. It's around about 99.5 million from memory. So that's the true audited value, confirmed by our auditors BDO, but also by our valuers Mazars. So that is the net asset value that we've published. Investors can see that in our annual report. That is the value of the company's assets. So
going back to what you're doing as the manager of this trust, explain more about your attitude now from where you go from here. Do you hold a lot of cash? Do you have investors putting money in and holding cash, waiting for an opportunity to buy into new areas? How do you deal with your exposure to these new areas?
So our capital is now fully invested and committed. Going forward, what investors would expect to see is we're currently in the process of building out a portfolio of battery storage assets, which you mentioned earlier. And as those come online, that will deliver, I guess, organic earnings growth, right? So that's, earnings on circa £40 million worth of exposure still to come online. So one would expect, income and further higher earnings going forwards over the coming year from the capital that we've committed. We don't have cash lying around. We're putting it to work to earn returns for our shareholders. Do you know of any areas you'd like to be in that you aren't at the moment? Do you view other niche areas you think perhaps maybe are underserved for the investor? Because, as I said, we as an investor community are looking for opportunities to get into these areas, which are, so far as I'm aware, pretty much untapped, and certainly individually. I mean, you've got a trust here which is made up of a number of niche areas, some of which, of course, some viewers will never have heard of before, including myself. So this is an opportunity, but it also, I guess, means a risk. Yeah, it's really important to think about risk-adjusted return. Most people just talk about returns, don't they? So when you think about the risk in our portfolio, the way I would think about it in energy is how much exposure to the power market am I taking? It's a volatile market. We were just saying there's negative prices in 2020, and yet we're on the lower record highs in 2022. Do investors really want to be on that roller coaster of up and down, or do they want a more contractual, solid income play? So TENT has got 92% of its earnings contracted, and that's 92% over the next 10 to 14 years. So an extremely long time horizon. That provides visibility of earnings for shareholders. That provides more confidence in the revenues, the dividend cover, and the earnings we can achieve. And that, to me, is a really important part of why I think TENT is one of the more attractive risk-adjusted returns in the market, because when you don't take 100% merchant risk in terms of how much you can sell your power for, you are ultimately, therefore, better downside protected. And so that's what we think we're providing on the risk side. To your point around technology areas, yeah, we've gone for those niche areas because they deliver higher returns, or all things being equal. So you get a higher risk premium on hydroelectric power than you do solar, for example. You get the same subsidy. That seems a sensible thing for us to do. The assets we have scarcity value. So we have 9 run-of-river hydro assets. There's only 400 in the UK. There are a lot more than that solar farms, as of course your viewers will know. So we really will continue to focus on those niche areas. And the first part of your question was around interesting new areas. We really see the electrification of transport, EV charging, and EV infrastructure as being a really great opportunity, particularly in commercial and commercial fleet. Where you can have good, solid counterparties paying reliable levels of income. That's where we really see big opportunities going forwards, and we'd love to be able to do more of that going forwards. And maybe a bit of green hydrogen as well, actually, quite an interesting area where we're starting to see some good opportunities in our pipeline.
That is a very good point, actually. I'm talking a lot now to CEOs about this new area. Green energy is fascinating, I think. Another niche area at the moment, certainly at least. If you wanted to get into a new area and you're not holding cash, how do you deal that? You take on debt, do you? Or what's the way in which you engage with a new and untapped area?
Yeah, so I think for us, clearly for us, it's about being able to raise additional capital from our shareholders. What we want to do is, this was our second full year of results. For us, it's about being able to raise further capital off the back of that to invest into those new opportunities. We shared in our annual results that our average pipeline return is 9% or slightly higher. And I think that's really, really good in the infrastructure sector. You'll know that many infrastructure companies are yielding slightly lower than that. So we've got this really attractive pipeline of assets that we're keen for shareholders to come on board and help us invest in.
Yeah, it's a pleasure, Jonathan, to be able to catch up with you. Certainly an interesting area, and we look forward to hearing how things develop, and as the market begins to recover, what the upside is potentially for the Triple Point Energy Fund. But thanks indeed for joining us.
Thanks for having me.
That's Jonathan Hick. He's the manager of the Triple Point Energy Transition Trust, which has the ticker here in the London markets of TENT.